We have a very, very full program, so I appreciate your attention. My name is Richard Joy, and I'm proud to launch our 12th ULI Toronto PwC Canada Annual Trends in Real Estate program. This morning's event, by the noise, is evidence of the fact that it's the largest that we've ever hosted. Almost 700 of you have registered and are attending this morning. We've had to even move to this venue, of course, to accommodate the growth for those of you who've been in years past. It reflects, I think, a growing interest in the Urban Land Institute, which has more than doubled its membership in the last 2 years. Now we're 1,500 strong. What we do seems to matter. I want to first acknowledge this morning's event sponsors. Quadrangle and RJC engineers who are up here at the front, their support was critical to the success of this morning's event. I also want to acknowledge our annual sponsors whose ongoing support has been at the foundation of our growth and impact across the Toronto region. And finally, I want to thank our over 40 table sponsors who've electrified this morning's event with your generous support. So thank you to all our sponsors. Most of you will know ULI for our great educational programming. By presenting a broad array of future-focused, internationally inspired, and professionally diverse city-building topics, ULI's programs can be relied on for being contextually informed and continually relevant. And we are significantly expanding our offering of smaller, member-only events as well to bring ULI Toronto members into a more intimate dialogue with international experts, regional thought leaders, public policy makers, and opportunities to get behind the scenes of a wide range of development and infrastructure projects. That every one of our member-only events has been sold out speaks volumes, I think, to their success. So expect more of these. We also have become the organization of choice for leadership and career development. From our mentorship program to our Women's Leadership Initiative to our ULI Connect, that's our under 35 early career professional focused initiative, we are creating unique career development and networking opportunities. And these initiatives have in turn shaped who we are. 1/3 of our membership are women, and half of our membership are under 35. And this month we are excited to be launching our first annual mid-career oriented urban leadership program led by former Chief Planner Paul Bedford, who's here in the room somewhere. Paul, I think I see you. The announcement of the first class of 30 for 2017 will be made in just a couple of days, so stay tuned to that if you've applied, but we're very excited about that. We're also an organization that's committed to education, so it is with tremendous excitement that we are launching Urban Plan, ULI's internationally acclaimed high school-focused program that introduces the world of real estate, land development, and city building to grade 11 and 12 students in Toronto. Allow me to pause on this one just for a minute because we do have a little recruitment announcement. We need some volunteers to help make this work. We need 20 in total. Industry volunteers who will actually spend just a few hours over the coming years, a few hours a year, working in classrooms to help make this program a success. And we have a session that's going to launch this coming up later in this month. So if you're interested, we're going to be sending an email around to everybody later this morning. But also, approach me with your business card or one of my team, and we'd love to take your name down. Enough advertising, but there is no better way to give back, I think, than this. So we hope you might be interested. We need 20. Finally, I want to turn to Electric Cities. This is our outreach program that seeks to expand the realm of our work beyond the professional spheres of private and public sector professionals, to bring city building and urban transformation to community. Launched at our annual Meet the Chiefs dinner last spring with the senior municipal planning leadership around the region, Electric Cities is an initiative to put ULI Toronto directly into the front lines of communities across our region. And this community focus will extend to our upcoming spring symposium, cards of which I believe you have on your desk, on your tables. This is our symposium that will continue to further our exploration of the themes of mobility, placemaking, and technology, and registrations for that are now open, so please get the early bird rate by acting soon. Turning to this morning's program, it is with tremendous pleasure to introduce one of the principal authors of the Emerging Trends in Real Estate Annual Report, which I think is in its 36th or 7th or 8th year, maybe. Andy will tell us, and that is Andy Warren. Andy is no stranger to this audience, having anchored this program for many years. He is responsible for monitoring all aspects of real estate, including space market fundamentals, capital market trends, regulatory changes, and operational developments. As we have experienced, Andy brings extensive knowledge in the real estate life cycle, specifically the analysis and potential impacts of economic fundamentals and capital market influence on the real estate industry. He has also had significant experience in developing and implementing real estate investment strategies across the risk spectrum. Prior to assuming his current role, Andy served as the Managing Director of Real Estate Research for Principal Global Investors, the fourth largest institutional real estate manager in the U.S. Andy earned a Bachelor of Science degree in Finance at the University of Nebraska and a Master of Science degree in Urban and Regional Planning at the University of Iowa. He has earned the right to use the Chartered Financial Analyst, CFA designation, is a counselor of real estate, a member of the Appraisal Institute, and the International Council of Shopping Centers. Following Andy, PwC partner and ULI treasurer Nadia King will take over the program as our MC and moderator. Nadia is a partner of PwC's real estate practice, where she has a broad range of experience with clients in the industry. Nadia's past and current clients include property development developers, commercial and residential property owners, property managers, construction companies, as well as hotel owners and managers. She has significant experience in the area of audit, accounting, tax systems, and controls. She has experience assisting her clients in transactions such as acquisitions, restructurings, and prospectus filings in Canada and the United States. She holds both a Chartered Professional Accountant, CA, and Certified Public Accountant designations in Canada and the United States, respectively. Finally, while not formally part of this morning's program, I want to acknowledge the editorial leadership of PwC's Chris Potter, Miriam Gurza, and Frank Magliacco, who is also a former ULI treasurer. It's a pleasure and honor to work with such fine individuals. So, without further ado, I will now invite Andy Warren to kick off this morning's presentation of the 2017 Emerging Trends in Real Estate program. Andy.
Well, this is great. Good morning, and thank you for having me back for a fourth year in a row. Every time I come to Toronto, I go through tremendous construction in Union Station, but I finally gotten to the point that I think it's just progress and you're not trying to confuse me and keep me out of the city, so I'll take that as a positive, and it's great to be here. We'll see if we can get this started. Got ready to do this year's presentation for Emerging Trends. I guess I'll go ahead and start before the slides do. And one thing you can always tell, and the team here in Canada did an excellent job of putting the Canadian content together, because putting the presentation together was fairly easy. Everything looked good and kind of went together. But overall, the theme for Emerging Trends this year was kind of playing for opportunity, guarding the flank, which is a similar theme that we've had in past years. And it's really, there's opportunity out there, but people are still very interested in really how to protect the downside. You know, there's a lot of things going on that we'll talk about that kind of make it look like, oh, I'm moving that way, okay. I guess I can't see it here. There's a section on technology coming up later. This is an example of how not to do it. Okay, there we go. Kind of to follow on Richard did, 38th year for the report overall, and as I was going through getting ready for this, I realized this is the 10th year that we've included the Canadian chapter in the Emerging Trends, so a little bit of an anniversary there that I'm not sure we celebrated appropriately. It's really the contribution of all of you that make this possible. We go out and we do interviews. This year we did over 500, close to 600 interviews in total, 115 of those here in Canada. We send out online surveys. We had over 1,500 responses total close to 250 of those were from Canadian investors, market participants. So thanks to everybody for that. It really kind of gives us a sense of what's going on in the market, and we really like to start with the sentiment as to what people are thinking. And to kind of put this in context, we do the interviews and the surveys roughly in the June to August period. So as I go through some of these comments and some of these numbers, kind of keep that in the back of your mind, because it's important, because we've discovered as in a dynamic environment as we're in today, the people's perceptions and ideas kind of tend to change. So we'll kind of think about that, maybe think about some things that are a little different now than they were 3 months ago. First of all, the overall, we ask people, what's your expectations for profitability? To kind of give you, what do you think your business is going to be in 2017 compared to 2016? And you can see it's pretty strong. It's, we've got close to 75% of the people feel the outlook for profitability is good to excellent. The rest are mostly fair. Get that 1% group that are poor to abysmal. And if we look at that 246 of online surveys, that means there's 3 of you that don't think next year is going to be very good. Fortunately, we keep the survey anonymous, so we won't be putting your pictures up here each year. But as we talk about this, we always think it's that one guy that's doing this. We compare this to the U.S. The outlook in the U.S. is a little more optimistic. Maybe that's foolhardy. Maybe it's a little more opportunity there. A little less pressure from oil and gas prices in the U.S. So that market's kind of looking at kind of where to go. We're up at that 81.3%, which was a little bit of a surprise to us. We kind of thought it might back down a little bit in 2017, coming off about 3 or 4 years of very strong optimism. We break it down by sector. I think the takeaway here is everybody feels pretty good about 2017 coming up. The key is we just don't feel quite as good as we did last year. So it's kind of pulled in just a little bit, which maybe it's a little counterproductive to the previous look at that, but it actually, I think it reflects what's going on in the market. Investors, owners, feeling a little bit more like they can see what's going on. Service providers may be a little less optimistic. I think that could come from competition, being squeezed a little bit in terms of market share. We kind of ask people, we go, okay, give us 3 words that you would use to describe the market in 2017. And we kind of, balance kind of came up. Then we had, some others come in, and these kind of run the spectrum. We had some very negative opinions. We had some very positive opinions. But really, kind of growing, measured, uncertain, overheated, those were kind of in the top 6. And when we get to the top 2, cautious was the second most used word to describe 2017. And number 1 was competitive. So I think we've kind of got a market where people are being careful. There's a lot of things that can trip you up when you get to this point in the cycle. And there's a lot of people that are doing it, and the competition is more intense than ever. And through the interviews and talking to people over the course of the summer, the quality of the competition is extremely high. So even if a few people leave the table for a particular deal, the people that are there are quite capable of fulfilling what they promise. So it looks like a very interesting market going into 2017. Kind of as the underwriting criteria adjusted to this, and I think the big number here that jumps out is that increase in debt underwriting criteria being more rigorous. Quite a change from last year where we were thinking it was going to actually be, stay the same was the dominant number. If we look at equity, kind of the same thing, only a little, not quite as dramatic. I think that's probably because the equity that's out in the market right now is a little more disciplined and probably had self-regulated itself a little bit more going into this point. Here come the trends. I was looking at this morning and listening to the news about the U.S. election, and it came to me, this is probably somebody in Canada watching the horde of people come towards the border from the south. So, no need to build a wall yet, but maybe wait a week to see what it comes out. And kind of the trends, some top trends, kind of themes that came out of this year's report. And the first one I'm going to talk about is this building communities. And this is really mixed use, but taking it to a different context. And I heard an interview this week, actually, where somebody said, nobody ever says, I want to live in a mixed-use building. They want to live in a community. So the idea is to put together a building that may have multiple uses, but then you just kind of, can you create that sense of community around it? Do you have the green space? Do you have all the amenities that people want? As well as just the housing and the shopping and the place to work. So really, I think that's going to be important going forward, especially as we deal with some of the other issues like housing affordability, urbanization, where people want to be. Building communities is going to be a key, and that actually comes out one of our key best bets. We kind of hit a point that solving this puzzle in answering that question is going to be a success factor going forward in 2017 and beyond. And then our next trend is affordability on the decline, and this is speaking to housing affordability. And really kind of what we're looking at here is price to income, so median home price to what the median income is in the actual market. And you kind of see when you break it down, we've drawn those lines. You have Toronto and Vancouver, which are clearly outliers. These are markets, very strong economies, a lot of global interest in the housing market. So kind of pushing those up. Yeah, you see where the national average is, and then you kind of look at those markets directly below that. You're kind of looking, these markets are a little pricey, but not too bad. And then you kind of get the others, the bottom 5 there, kind of more affordable, so a little less of an issue there. But housing affordability is something that's going across all of North America. It's an issue in the US that we're looking at, and it's not a factor of housing affordability that people can't afford it, but just the concept of housing getting more expensive than the income growth can support. So really looking at, is it an issue of supply? Is it an issue of location? Is it building qualifications? What needs to be done? So a lot of opportunity to kind of fix that problem, but it's something that's going to continue to face the industry and be very important going forward. And that kind of leads into renting for the long term. And last year we talked about kind of the rise, and people were beginning to talk about rent by choice. And so thought it would be interesting to look at the renter households compared to owner households. And it's interesting, over the next 20 years, the forecast is for both groups to grow at almost equal. The rates are a little different because of the base, but we're looking at, maybe adding about 2 million rental households as well as 2 million owner households, which is a little bit of a change over the previous 30, 40 years there that we're looking at in this chart, where the dominant factor was to own a home. People are thinking about renting. They like renting because it's a little more flexibility. When you're at a point when the market is very hot, maybe it's time to take some capital off the table, so you sell your home, you rent. So a lot of options going forward that I think will make that important going forward, and that actually is the second of our expected best bets is purpose-built rental, kind of tapping into that market, figuring out a formula, because one formula doesn't fit all. Are you looking for a special market? Are you looking for kind of a mix to appeal to different groups over time? And this technology disruptors, this goes back to my being unable to run the clicker appropriately. But technology is something, and it's really not the advent or the invention of technology that is really maybe not surprising the industry, but is some people kind of taken aback. It's how fast it's being adopted. It's happening very quickly. And we all know how technology has changed the workplace. People are more connected. They can work from anywhere. Office space has changed. You no longer have a set desk, so you're hardwired somewhere. You can do your job from anywhere. So space layouts are different. But really, it actually is impacting, kind of how we're doing real estate in terms of, in the US, we talk about augmented reality, and how that's being used both to sell real estate, design real estate, show people, prospect tenants what their space will look like, how it's being used in retail to show people what items will look like for them. And, we came down to the question, and we added it to this year's survey. What are the factors that impact your location decision? And actually, technology readiness of a property comes in right below rent. So, it's viewed as being very important to where I want to be. And that was something, talking to people over the course of the interviews and reading the interviews, that came out is you heard almost as much about technology redundancy in their office building, and it reminded me of 20 years ago when everything was power redundancy in industrial. So it's just become a factor that you have to have it. Everybody wants more than they think they'll need because they want to be ready going forward. So technology is something that's not going to go away. I think it's going to hit every facet of real estate, from design, construction, utilization, and ultimately the trading of real estate. So it's just something to get ready for. And then global uncertainties weigh on the mind. It's been an extremely interesting year, and this kind of gets back to my comment about the time frame. Last year, we did the interviews and the survey in the summer, same time period. Then when we did these presentations in January, the U.S. financial market was in a little bit of a turmoil, so everybody had changed their opinion. So we thought maybe that profitability forecast I put up would be a little different, but it had kind of changed. Well, now look back, let's see, 3-4 months ago, or during the summer, the U.S. election cycle was not nearly as tumultuous as it is right now. So I think people, may have changed their minds as they kind of selected these. We see in that middle box, you kind of have a political landscape. Really wasn't viewed as being very important going into 2017. I think if we ask people that question today, that number might be a little more up there, a little higher. One thing that is kind of playing in is this terrorism war, epidemics, is viewed as important. That's something that moved up from previous surveys. People are very concerned about what's going on. And for the first time in the 4 years that I've been involved with the survey, city safety is an issue that we're beginning to hear about. It's not a category that we even included in the survey just simply because it has not been an issue before. We've asked about it, and it was low enough that we ended up taking it off. But particularly in the U.S., we're hearing a lot about, a market like Chicago that has, some issues with the murder rate, incidences in Charlotte, Dallas, places like that. People are beginning to think about that. There's not a direct effect on the real estate market, but it's something that outside investors are taking into account. And then ongoing oil and gas woes. I don't think I need to, tell everybody that, if you're in a particular market, that's going to hit very hard. Calgary is feeling it. Houston in the U.S. is feeling it. It's just one of those things you kind of have to wait out and see. We're looking at a market where, you look at this forecast from the Energy Association, and demand is going to go up. But the other side of that equation is very volatile, very dynamic, very difficult to control, is how much supply is going to be on the market. And ultimately, what's that going to do to price? And then what does the price do to production? And how do you get a different, probably the previous energy cycles in the 70s, would have devastated these markets. But I think the fact that we're in such a strong capital position, we're not seeing fire sales of properties in these markets. They're kind of holding on. People have gone through this before. They know how to kind of work through it. So it's a much more stable in these markets than it was before, but it's still painful and still is going to take some time to resolve going forward. Probably still be a significant impact in 2017. Hopefully by the middle to the third quarter of 2017, there'll be a direction so you can kind of grasp which way it's going. And then waiting for deals. This kind of gets back to that competitive factor. The markets are very competitive. People are looking hard for the right opportunity, the right yield. So we kind of looked at, is there enough capital, and asking people what they thought in terms of how much capital was available. And most people feel like it's imbalance on the debt side. I think that's good. I think there's always been, and this is something that's come out every year when we talk to people, there's always capital for the good deals. Maybe it's a little harder to get capital for the deals that are on the edge, and it may be very difficult for the deals that are, maybe probably shouldn't be financed to begin with. Equity, maybe there's still a little too much capital out there. I don't think anybody will question the fact that people are looking at markets like Canada. If you think about it with what's going on in the U.S. today, if Canada had more supply, I think we would even see more interest in investing here, because this is now the stable market in the northern hemisphere right now. So I think that's going to continue. People are still going to be out there. And patience is going to be required. You're just not going to be able to rush anything in this environment. And that kind of leads us to, so if you're being patient, what kind of deals are people looking for? And it really gets back to not a lot of change from last year in terms of people are still think industrial distribution is going to be the top performing asset class in 2017. Multifamily kind of jumps up there. It's a little bit of multifamily and single family are fairly close in this year's survey. And then, kind of like hotels, office, retail. The outlook for all the property types maybe is down just slightly, very marginal, so not really a significant move there. But what subsectors within these major property types are people looking for? And really the story, and this is very much a story in the US as well, is fulfillment centers, e-commerce. It's almost like industrial has become another segment of retail. It's just another place where you buy goods, you just get it there. One of our top best bets for the US is actually solving that last mile equation or same day delivery. A lot of opportunities to do that, so people are kind of looking for the best way to get the goods in the hands as quickly as possible. And then age-restricted multifamily housing. Truly a demographic play. Everyone's very interested in the aging of the population. Unfortunately, it's a very complex property type. Anyone here that's involved in that knows that there's a lot of elements involved. Is it age-restricted, just simply, but really fully independent, no special care provided, but just, kind of offers the amenities, which actually kind of fits into that people deciding to rent. Maybe they decide to do it in this type of community as well, just simply for the advantages. Interesting point, we'll see if it has any legs in coming years talking to people. People talked about age restricted, but they really didn't like the idea of having it just be one. So one idea people are really looking at is finding a way to make projects work that are attractive to baby boomers and millennials both. They both want the same amenity packages, so that works, but unit size and some of the things that go into the individual units are different. So how do you get the economics work so it's affordable for both? So we'll see if that is something that develops kind of going forward in terms of that. One person noted that if you have, people 60 plus and then you have people 20 to 30, that your strain on your elevators is almost constant because the old people use it early in the morning and the younger people use it late at night. So maybe you don't have to add as many elevators as you might need. Urban and high street retail continues to be very attractive across all of North America. It's very limited, very, very tough to get into, but if the opportunity is there, it seems to have virtually unlimited upside. Kind of development, kind of the same story here, still industrial distribution, warehouse, kind of the sector of fulfillment, kind of where to develop that space. And a lot of that's due to the fact that the industrial space we're using today has significantly different requirements than the industrial space that we used 10, 20 years ago. And the markets to watch. Kind of look, we're back to 2012 if you kind of look at the way the markets rank in our survey. Kind of Vancouver, Toronto have, spent a little time kind of in the middle of the pack, but now they're kind of back up to the top. They're the market, obviously in a market where you're looking for flight to safety, surety of return, they're attractive. They're attractive to domestic investors, they're very attractive to global investors. Calgary and Edmonton, kind of in the oil base, have kind of moved to the back, no change from last year. People are uncertain on those markets, taking a very cautious wait and see attitude. Really the biggest change when you look across how people are rating markets is really kind of Montreal has kind of moved from being middle, lower tier up to kind of in that upper echelon in the first three markets as people look for opportunities. So not a significant change here. I feel a little guilty when I try and talk to an audience like this about the markets here because everyone knows them better than I do. But I'm giving you my outside perspectives as I kind of look at these. So it's not really surprising. Anything jumped out at us this year in terms of 2017 for the markets. The markets that are doing well will continue to do well. Some of the markets later may struggle a little bit. And here's kind of our best bets. We kind of talked about the industrial property. Like I said, is it e-commerce, last mile, purpose-built multifamily rentals, senior housing, retirement homes. Like I said, very good opportunity. Just one of those that's very challenging. in kind of this, finally, the urban mixed-use development, creating that community feel around what's going on. Really want to know, give it a sense of place so people want to be there, not just simply because, you put up a building and it has some retail and housing combined with it. And then kind of a quick summary of the U.S. Like I mentioned, there's several trends: housing affordability, the industrial is very attractive. One thing is optionality, and I think that's something we're seeing. People are using office space a little differently. Maybe they're using it at one point, it's an office, and then in the evenings, you're renting it out for reception space or a club. People are looking at different ways of doing that. And really the extreme optionality example is a company that's all of their space is through a shared workspace. They don't even have an office. They're just contracted to kind of use space at different times. I think that's something that we'll see more of going forward, just kind of starting now, but that'll be something. And then we're struggling with labor availability, especially construction workers in the U.S. So we're looking at the need to either recruit new workers or train workers or retain the workers that are there. And that actually leads into one of our best bets, is figuring out how to implement new construction technology, which either kind of helps cut costs, makes it a little easier to keep workers in the workforce. If you're building walls in a factory, it's much easier to keep an older worker. They don't retire as soon. And then really the 18-hour cities continue to dominate our top 10 list. I think 7 of the top 10 cities in the US were 18-hour cities. San Francisco, Los Angeles were really the only holdouts from the gateway cities. Every other market really kind of was those 18-hour cities. A lot of interest in those markets, and it's interesting in that the national event in Dallas, we were talking about it, and somebody finally said what no one had said before, was Austin, Texas is a wonderful market. Everybody loves Austin, Texas, but it's also a very small market. So there's only so many opportunities in Austin to invest. So it's kind of that example. So really it's kind of, you're looking for that market that's Austin-like. But I think the interest in those markets is going to continue to increase, especially as more capital begins to look to invest. So all in all, I think 2017 looks like, it's going to be an interesting year. It's not going to be a year where you can sit back and just rest. Everyone's going to have to be, at their A game and on their toes. But it looks like it's going to be a very good year. And with that is kind of the base, and I think we're going to have a panel that is going to refute everything I just said, and then we'll find out what's really going on. Thank you.
Thanks, Andy, for your presentation. As Richard mentioned, my name is Nadia Kling, and I have the pleasure of welcoming our other panelists to the stage. So just as they're getting mic'd up, sitting next to Andy, we have Blake Hutchison. Blake is the Chief Investment Officer, Real Estate and Strategic Investments of OMERS, where he's responsible for about 20% of OMERS' investment portfolio. That includes the pension assets on the real estate side, as well as other investments in direct energy and other strategic assets. He's also the president and CEO of Oxford Property Group, where he is responsible for $34 billion in assets under management and 1,700 employees across Canada, Europe, and the United States. Blake has sat on several boards and committees, including being a member of the Toronto Mayor's Task Force on Affordable Housing in 2015, the chair of Build Toronto, the director of RealPAC, and the chair of the Canadian Real Estate Forum. Next to Blake, we have George Karras. George is president of Real Strategies, Inc. George is a PN and an entrepreneurial leader in the use of information technology in the Canadian property markets. Prior to his role at Real Strategies, George founded RealNet Canada in 1995, which helped transform Canada's property markets by providing stakeholders with relevant information in order to allow them to make better decisions in the real estate market. George is the past president of Toronto NAOP, the co-founder of the NAOP Rex Awards, and serves as on the advisory board of the Schulich School of Business program in real estate and infrastructure. And next to George, we have Paul Morisuti, who comes to us with over 25 years of experience in valuation and advisory services in all facets of institutional real estate and land development. He currently leads CBRE's valuation and advisory team in Canada. Paul is a member of the Royal Institute of Chartered Surveyors and sits on the advisory board for the Schulich School of Business MBA program in real estate and infrastructure. He is also a director of Artscape, which is a not-for-profit organization where he chairs the development committee. Welcome, and thank you for joining us.
Okay, just have to figure out how that works. So first of all, good to see everybody this morning. They've been producing this document for 38 years. To date, myself, I've been reading it for 33 years. And I have to say it is a definitive document in our industry. Good work to all those who are involved, and thank you for keeping it going. As we suggest, we get to reflect or refute what we've heard today. And so I'll just start by talking about the U.S. market, then I'll talk a little bit about the Canadian market. Each of us kind of have 5 minutes, then we'll retreat and we'll get into a bigger dialogue. So first of all, update on Oxford. When I was here 7 years ago, new to the role as CEO of Oxford, we were a $15 billion business, 94% invested in Canada. Today, actually, we're a $43 billion business, 55% invested in Canada, 45% invested around the world. So in that short period of time, we've grown at a pretty good pace. Our goal today is 20-20-20 by 2020. We're going to have $20 billion of owner's equity, $20 billion of debt, $20 billion of third party. So our ambition is to wake up in 2020 a $60 billion business from 10 years prior. So that's a 10-year run, quadrupling the size of the business. I'm here to say it's a good time to be in the real estate business, notwithstanding Brexit, notwithstanding what's happening with the U.S. election, notwithstanding the oil and gas business. If Oxford's a proxy for the business, it's doing really well. We've averaged about 12.5% returns for the last 7 years. We've been able to diversify into all asset classes, and most of the asset classes reflected here by Andy, if you can find a way to do it, can work in the context of the business. We've been able to diversify the portfolio not only geographically, as I suggested, to the US, the UK, to France, but within the Canadian context. And so it feels pretty good to be in the real estate business, and I think the optimism that's been reflected in this document speaks to our book and our portfolio and our experience. So just reflections, refutations on the US market. These are the things I agree with. I had a chance to sort of just tick through, and clearly the US is in favor in a global context, notwithstanding its issues. There's 200 countries in the world. There isn't a country out there that doesn't feel they've got issues. It's like every family, right? We all have our crosses to bear. So I was in London earlier this week, and they're fretting, obviously, about everything that's going on. But frankly, if you're in Europe with the contagion that's on the precipice in Europe, you're actually still happy to invest in London, notwithstanding the fact that those in London fear that that's not the case. So when you circle around the world and look at issues in Europe, look at issues in London, look at issues in Paris, look at issues in the Middle East, look at issues in China, look at issues in the emerging markets, you come back to the United States. So clearly it's in favor. There is no crash near or in sight. Fundamentals are strong. The wind is at its back. They have learned painful lessons, not only the financial and lending institutions, but the developers and the like. There's no big oversupply problem. The financial crisis was a teachable moment. I think that was a very good comment in the document. Will there be modest further decline in cap rates? We think so. I think that's a reasonable assumption. And technological advantage equals return advantage. That was a big theme in this book. Absolutely the case, whether it's construction technology, whether it's wiring your product to make sure that you've got a competitive edge. If you're not focused on that, you can't be in the game. So all good things I agree with. Smart cities make sense, are your top markets. Total rise of the shadow banks with the regulation that's going on. Institutions, big and small, are finding ways to fill the white space that banks heretofore had provided. We're seeing it everywhere, including our own book. We've got a $2 billion credit book in the United States that we never would have had the bank regulation not been imposed. You're seeing it, it's alive and well. People are filling that void. Labor scarcity for construction is a real issue. You're seeing it globally. There just aren't enough people in the pipeline coming through to satisfy that demand. Retail sales experience, no question. It's an old theory, but it's a fact. Goods are secondary. It's all about experience. And when you put out your order of priority investments, we're in Boston, Washington, and New York. And in the order that you presented, we agree with it, that it's Boston today as a tech center with 100 universities and colleges is absolutely on the forefront, we think, of a big boom, net effective rent increase. We've only been investing there 3 years. We're now the second biggest office owner in the city of Boston. So that shows you the religion we have for that city, followed by New York, followed by Washington. Washington has the office leasing is a proxy of how much legislation goes through, and we all know what's happened in the last 8 years, so it's pretty sleepy. And, when you look at your asset classes, I think you talked about industrial, office, general retail, but clearly high street retail and fortress malls are still the best investments you can have. They're just really hard to get at. And so most of what you've said, I think I agree with. Some things I would say I look at a little differently. You talked a lot in the book about small developers driving most innovation. I have to tell you, with our Hudson Yards project, and I have a brief video on it, the innovation that I've seen come from really large projects with the best of the best engineers, architects, financial players, et cetera. I don't know how many patents and great ideas have come out of that project for us, but it really has fundamentally changed the way we look at the business. So it's not just small developers, not taking anything away from them. I'm seeing it at a big scale. Connectedness equals the suburbs. That was a theme in the book, and I think a lot of people are suggesting today that because you can be connected, maybe it's okay to be remote. We're seeing the exact opposite with all of our trends, and frankly, our investment thesis supports urbanization insofar as the more people can be anywhere, the more they want to be somewhere. And no matter what we see with technology, people want to be in urban centers, they want to be in social fabric, and that we think is a bigger trend than you might have suggested in the book. There's a lot of this talk about blockchain. I'm more nuts and bolts. I'm talking about block and tackle. I have had more dinners with people talking about blockchain and what it means, and I'm sure there's a religion. I'm sure we can learn from it, but when you're running a business, you wake up, you do the little things well. That, to me, remains the focus. They dedicated a whole chapter to that in the book. I'm not so sure I would have. I was surprised, actually, when they talked about, particularly in the U.S., the hierarchy of their concerns, their participants' concerns, and the political landscape was low, given all the noise about this election, and I suspect that was just a question of timing when the book was, when you gathered the data. It was institutional capital was referred to in sort of a holding pattern way, and I'm just here to tell you that we don't see it that way. Because even if you're a huge organization with a finite amount of equity, all these organizations have become living organisms with trading in, trading out, very, very active. So while it may look to the outside that an institution's in a holding pattern, I think there's a lot more activity going on across the board. And, I think the one big theme that might have been missed is I just cannot tell you, and it's our dirty little secret, and I hope everybody in the world doesn't figure it out, but the biggest opportunity by far to manufacture returns is the development business. And when we look, if I take 100 Adelaide down the street as an example, we're currently working with that product. It's going to be completed in September of next year. It costs us $500 million to build that real estate with full roll-up of cost of carry land and everything else. So $500 a foot. $500 a foot. At completion will probably be a 7 or 8% NOI yield. And by the way, the value over the cost at completion will be probably 40%. So you can manufacture 40% value over cost, you can pick up a 7 or 8% yield on your return, and your cost base is $500. Or I can line up at an auction, won't mention any buildings, I can pay a 4.2 cap, pay $800 a foot for a 40-year-old piece of real estate, and not get a development profit. So today we have 23 developments around the world. We're investing $7.5 billion. They are by far and away the best way for us to manufacture incremental returns. And the reason why we've been north of 10% for the last several years is 100 to 200 basis points a year are manufactured for our whole portfolio just by being in the development business. Yorkdale alone, if you haven't been up there, that recent expansion roughly $350 million. I think our value over our cost there would be 50 to 60%. So it shows you something that to me wasn't captured as a real theme. Now, not everybody can have the expertise or the opportunity to develop, and I get that, but that's the case. I've put this short video, it's just a couple minutes, and it tells you, to me, how we look at America, because it's our investment in the Hudson Yards project. This project is, restoring hope, which I feel is a cornerstone for America today. It underscores many of the themes that are in this book, which is live, work, play, innovation, new, all those things. And rather than say anything more, this video will say infinitely more than I can.
They say you can tell you've become a real New Yorker the minute you stop looking up. Looking up's for the tourists, for the recent transplants, the people who don't have work to get to, a train to catch. Looking up's for the dreamers, for children who haven't yet outgrown their surroundings, for anyone wide-eyed enough to believe New York still lives up to its namesake as someplace new. But we've heard a different story. We hear there are still neighborhoods to explore, still places to get lost in, still secrets worth finding, that there are still victories to toast, stories left to tell and be told, heights worth climbing, that there are still connections to make, perspectives to consider, and celebrations to come. We've heard that there are plenty of reasons to keep looking up.
The message really to me is hope, and the message to me is innovation, and the message to me is U.S. is alive and well. We totally believe in tomorrow, right now in America, and that project personifies how innovation mixes with great real estate, mixes with a pretty terrific market. On Canada, just a few quick slides. It is a tough marketplace to grow. We're all hopeful for GDP growth of 2%, so let's not kid ourselves. I think that's reflected in the book. Live where you work where you play, etc. Work where you live, all those things are real themes of today. And, a fundamental difference to us between Canada and the United States has always been, if you grow up in the United States, you want to live and work down in the suburbs. Everybody's dream, the American dream, was always to have a big house in the suburbs, live in the suburbs. In Canada, the dream has always been to live and work downtown. And that's even more alive and well today, in our view. Mixed-use projects we've talked about, retail-tainment, I like that word, haven't seen that word. It does speak to the retail experience. Residential, long-term growth, we see it. Green and innovation, we do not look at any green or innovation as an expense. It's all an investment. It's a win-win-win environment, we agree. And we 100% agree that Vancouver and Toronto are the places to be. Where I would say that we look at things a little different, I don't think you can still be wrong and be right in Canada. And I don't think it's a low-risk place to invest your money today. I think you have to be very careful today. And so we're totally committed to this country, but we're being very careful as to where we put out money, and we just see it's a pretty, supply and demand's out of sync in a lot of places, and you have to be more careful than this book might suggest. The oil and gas wounds rebound, we don't think so. It's certainly not in the short term. Because we have a big oil and gas business in Alberta, we meaning OMERS, and I sit on the board, the best advice that I've had so far in the last 3 years as we manage this business down is through the smartest investment banker I knew out there, who said, by the way, your oil and gas business isn't like your real estate business. If you have the best team in the world, you'll get 15 points out of 100. If you get really lucky with your real estate, you'll get another 15 points out of 100, and the remaining 70% is what the Arabs decide. So lucky you have a business where you can control 15% of the inputs, And that's our reality right now in Western Canada, and there's not a thing we can do about it. We just have to let this ride out, and our view is this cycle's longer than what this book might suggest. Global political uncertainty drives decisions. In our country, I think it's local political uncertainty drives decisions. Most of us in this room are making decisions on whether we believe Notley's going to get it right in Alberta, or our mayor gets it right in this city. It's a much more parochial mindset. And while the book said good things about Montreal, Ottawa, Calgary, Edmonton, we're finding all of those markets to be trickier than the book might have suggested. So those are my reflections and refutations. I'll pass through those slides in the interest of time. I'll leave you with this comment. If I were to pick a theme today, it's from Mr. Darwin, which is, it's not the strongest of the species that survives, and it's not the intelligent that survive. It is the one most adaptable to change. And we're finding, even though we're part of a big organization with 2,000 people today, the innovation, the change, the way we're looking at things, the speed at which we're moving, that to me is a competitive edge, and that's what we need in this environment, in this country today. So with that, I'll turn it over to my good friend George.
Oh, I love it. Darwin. Good morning, everyone. Thanks for the opportunity, PwC and ULI, to be with you here this morning. I think when you go through the text in the 27 report here, I think you're going to find a great body of research included. But for me, and I think from the res sector, I think the cut line to the Canada section, innovation is by far our biggest issue. I think that's the ball game. So Andy had me at hello on that one. And I think that's really important because innovation is about applying different thinking to the problems that we now have. And innovation is actually a new trend in Canada. Trudeau in Davos announced he's going to pivot our economy away from resource and towards resourcefulness. In the summer, the feds announced the innovation agenda, identified 6 key action areas, and decided they're going to apply a more nimble policy approach. We're going to adapt policies as changes to the economy and technology take place and get rid of ones that don't work. So you read this and say, that's fantastic. Unfortunately, housing's not part of that. In 1.0, perhaps in 1.1 it will, because now you're seeing groups like the CVCA and the Conference Board weighing into that and saying, hang on a second, you don't have enough skilled labor in the innovation ecosystem to do all that, so maybe you should boost your skilled immigration numbers up and maybe get immigration up to 407,000 people. And of course, McAllen this week kept it at 300,000 people. But the point there is you still need a lot of immigration in this ecosystem for innovation, and that touches housing. And Canada has to compete in this global innovation economy. One way to sort of think about that is through this lens of tracking unicorns. And unicorn, of course, is a privately held company worth more than $1 billion. And you can look at this and the acceleration of the formation of some of those companies. And looking for the Canadians on this one is kind of like playing Where is Waldo? There is one or two. But I think the point is that's up until now. What we do around innovation and housing, quite frankly, is going to be a real teller on how that works. And interestingly enough, on immigration, the Wall Street Journal looked at the American companies that are on this chart. They found that 51% of those unicorns were actually founded by immigrants to the US. Now, another emerging trend, and Andy talked about it, was the reference to this word, augmented reality, in the report. Now, it took place early on in the American section, so you may have thought it was about the election. It's not. So listen, there are 3 kinds of reality. There's reality. Light comes off an object into your retina, you see the object. There's virtual reality, where light is emitted from a device to your retina and you perceive the object. Sidebar, on the journey between 4K resolution and 8K resolution, the human eye is incapable of telling the difference. Augmented reality is this unique mixture of both, adding a virtual layer onto reality. Now, Gardner predicts that this technology is going to hit productivity plateau in about 5 years. I think what you're going to see is things along the way that might feel kind of gamey and toy-y. Make no mistake about it, this is a game changer to skilled labor. So a few things to think about. Here's one. This is a company that maybe not a lot of people heard about, Magic Leap. It's valued at about $4.5 billion. Technologies and stealth, Series B and C investments, about 1.3 from Google and Alibaba. The way kids learn about blue whales in 5 years is going to be very different. When you think about in real estate, here's a company 3 years old, Meta. You're able to actually use hand gestures, this is real, to take virtual objects and move them about in real space. Also in construction. This is used this year in building a $70 million school in Boston. On the job site, they actually found, by integrating the virtual layers to this, they found a default with the steel framing, caught it in time, saved a messy change order and project delays. The real adoption, and that's one of the emerging trends here, is in construction technology. It's less about the technology here and more about job site safety. The more real these things look, the scarier that becomes for having people on that job site. One other thing that was mentioned in the ET was the importance of connected cities and the fact that today there are more things connected to the internet than people. Now, that's really important for really the real ushering in of smart buildings and smart cities. And that is where sensors and devices are attached to roadways, power grids, infrastructure, buildings to really help bring that into fruition. And another emerging trend that was mentioned was the last mile of e-commerce connectivity, tied really to smart cities. Why? Well, the first evolution of e-commerce, is anyone going to use this? And that, of course, they did. The next main focus of innovation was in long-haul distribution. And that's been really well accomplished. In fact, 47% of Americans now live within 20 miles of an Amazon distribution center. The real focus now on this e-commerce innovation is in the last mile of delivery. That's why we have our mayor looking at how we're dealing with traffic, and also things like where we're going to put the parcels in the buildings that we have. Great innovation is used by a lot of people. When a lot of people do things differently, that's disruption, and that begets new regulation. And you're seeing a cycle of that that's increasing in great frequency. We saw that here in Uber. In the US, it's very much alive with things like Airbnb. And I think an emerging one, maybe talk a little bit about, is co-living. I was at the We Live building last week in 110 Wall Street. Fascinating experiment, maybe a role in housing going forward. But in the housing markets, I think what we have to realize is housing operates within a policy framework. And emerging trends identified big A and small a in terms of affordability. There's affordable housing and housing affordability, two very different things. But affordability is an outcome of a behavior of the property market. And while we've got, alarm bells, red lights going off, really no one is in charge of the housing market. And what's worse is we have a number of different government policies coming from different sides that are, quite frankly, unaligned, that are going to come to bear to this market and make it feel somewhat like a piñata. Let me give you a sense of that. And on the right, there's some cost-push policies that are coming across. The province's review of the growth plan this year, essentially denial, or maybe let them eat cake. Moving the intensification targets from 40 to 60%, the density targets from 50 to 80 person jobs per hectare, and that's left pretty much all the municipalities and the industry saying, how exactly are we going to do that? We have inclusionary zoning now passed in September. Really net, this is probably a $15 to $30 a square foot sellable cost, and who's going to pay for that? I think that represents some very real risks in the short-term land market until we figure that out. So new Condo Act, Bill 106, that's coming soon. It's surprising how little people are talking about that. Change the way we actually sell condos, and particularly look at things like condo maintenance fees. Now this is all on the res side. I mean, there's a parking tax issue on the commercial side. I'm not sure if Paul or Blake may want to talk about that. But while you have these cost push forces happening on the right side here, you have these price reduction policies happening on the left side. We have new mortgage rules. We have a new housing task force that's coming to bear. The results haven't been introduced yet, but this is an all-government task force. So bottom line for the market, brace for impact. To expect to find solutions in this area with the same thinking that created the problems is hardly innovation. And I think it's going to be really important in that thinking here for this region, because Canada, Toronto plays a very important role in Canada. Toronto is to Canada what New York, LA, Chicago, Dallas, and Houston together are to the US. So innovation is by far our biggest issue, and I think therefore also our biggest opportunity. Thank you, and I'll hand it off to Paul.
By the way, before I get started, earlier this year, George and I talk all the time. George asked me how much I knew about augmented reality. I don't know if you remember this, and I told him I own a place in Miami. I see augmented reality all the time, and apparently I was confused. But I'm going to approach this a little bit differently from Blake and George this morning, and I'm just going to try and go through some of the themes and threads that I picked out of the Emerging Trends report and sort of tie them into my world and talk about some of the things that I think are having a significant impact on the market in general in Canada, and then a little bit more specifically here in Toronto. Number one, this notion of we are without question now in a low growth environment, potentially for some time. Everyone has seen forecasts like this and headlines like this. I think the Emerging Trends report referenced the most recent Conference Board of Canada forecast, and in the report it indicated that they were projecting Canada to end up 2016 with GDP growth of about 1.7%. We will end up 2016 with GDP growth of closer to 1.1, 1.2, maybe 1.3%. It's been revised downward every month since the summer, and it's being revised downward in virtually every country in the world. So this whole issue of how will this impact on the market fundamental side, how does this impact job growth, demand for space, rental rate growth, on the capital markets side, what does this mean for the cost of debt, for interest rates, for the type of return that we're going to expect to see on assets. The fact that we're seeing 3% and 4% cap rates, which I think we're going to see for some time in the future, is partially because of this phenomenon. And then secondly, this whole issue of geopolitical instability, I do think is a legitimate issue, and I am seeing some of the consequences of it here in Canada. I thought I'd use this as a representation. This is the Electoral College map in the US. I think the garbage fire of an election that's going on right now is not really the issue, and I think whether Hillary wins or Donald Trump wins is not really the issue either. At some point, the market will settle. The issue, though, if you look at this map, both coasts voting one way, the interior, more rural United States voting another way. This notion of a growing sense of the population throughout the world that feels disenfranchised, angry, they feel left behind, that force is only growing. It's not going to go away after the election. In Britain, it was that exact same force that resulted in the Brexit decision. The City of London basically voted to stay. Everyone outside of it voted to go. That was a very emotional, not a reasoned response. And in the EU, we see those forces resulting in people like Marine Le Pen in France, and some truly frightening right-wing political parties in Poland and in Hungary and Germany. Those forces combined with that slow growth issue, I think that macro backdrop has a big impact on what we're seeing in Canada. If you had asked anyone in January, what do you think investment activity would have looked like in 2016? I think most people would have said it would have been muted, it would have been modest. We blew the doors out. A record first half of investment activity, surpassing the previous peaks of 2007, 2012, and from everything that we're seeing, we think we're on track for a record year. If we don't hit a record year this year, it'll only be because some large deals have spilled into January. That's fairly remarkable. I don't think anyone would have predicted that. The other part of the market I'd like to just touch on is the REIT industry in Canada and how it's changing and evolving. The point I would make about REITs, and I think the panel discussion will pick this up a little bit, is they're maturing. The past 20 years of the REIT involvement has really been all about asset acquisition. They've been asset acquisitors for the last 20 years. Market conditions have been incredibly supportive of that strategy. Ever declining cap rates on the back of ever declining interest rates. Perfect environment to bulk up every single deal that you do as accretive. That environment doesn't really exist anymore, and they're now transitioning into a new phase of their growth. I don't think that's a problem for REITs. I think it's just an acknowledgement that they are a more mature industry now. Who is buying in Canada? We've heard a lot about the rise of foreign capital. Between 2012 and 2015, this is what foreign capital looked like coming into Canada. And in the first half of 2016, this is what it looks like. A complete reversal, China and Europe leading the pack, most of that capital going into Vancouver, Toronto, and to a lesser extent, Montreal. A couple things that I want to touch on, and George sort of led us into this. Huge surge in tech demand in office markets across Canada. This is some research that CBRE has done. If you look at high-tech job growth, it's pretty interesting to see that Toronto ranks right between Silicon Valley and New York. I think that explains a lot of the activity that we're seeing here. And when you look at tech as a percentage of all new office jobs, look at Vancouver, fourth on the list, 74%. That's pretty remarkable. Lastly, here in Toronto, from an office perspective, the engine that has traditionally driven the office market in Toronto has been the financial services sector. And the rise of fintech companies is something that we are watching carefully, because there are as many as 4,000 of these little startup companies. They are competing with the banks at every single service line. And if you listen to Jamie Dimon, who's the CEO of JP Morgan, they all want to eat our lunch. So this dance between the fintechs and the banks is going to be very interesting to watch. Will it fuel more office demand, or will it actually remove demand? And how will the banks react? Will they team up and collaborate with these firms? Will they compete with them head on? It's a very interesting dynamic that we're watching very carefully.
Thanks, everybody. Can you guys hear me? Okay. One of the themes that seems to be consistent across all of your presentations and reflections is the theme of disruption, and it sounds like technology is really at the forefront of that disruption that's coming forward. So George, my first question is to you. Given all of these changes that we're seeing, do you think us as a real estate industry are moving fast enough?
Yes, I think yes and no. I think we are moving faster than we've ever moved before. If you look at investments, prop tech as a thing, which it is, 200 million about 5 years ago. Last year was about 1.7 billion. This year probably about 3 to 3.5 billion. So we're actually growing a lot. Most of those investments are at seed stage, so we're actually creating a lot of new platforms. The challenge, though, is technology is really now at an exponential growth level. Even in the Valley, like the level of technology building on another technology is moving very quickly. So I think we're moving faster than we ever have. We're learning more than we have before, but I think it's not over.
No.
Do you know what's interesting is he throws out a couple $2 billion being invested in prop tech, and Paul showed a picture of $2.2 billion of foreign capital being invested in hard assets. So you look at, it looks like a big slide seeing the influx of Chinese investment, but the number of 2.2 is astonishingly low. The foreign capital being invested in hard assets in our country has always been 5% of the total activity volume. So when there's more getting invested in technological ideas for real estate than all of the foreign capital in our country, putting it in perspective, it's actually, speaks to the volume of this and to the not so much volume of the other. Yeah.
Right, no, absolutely. And I think that growth is going to continue to change and evolve, which I think is fantastic. It's very exciting. So in speaking about growth, Paul, in one of your slides, you were talking about the increase in tech-related office demand, which all sounds all well and good. There's additional demand for office space, which is fantastic. But is there any potential downside in relation to this change in demand?
Yeah, I mean, on one hand, we love to see the economy diversifying and demand diversifying, and so the increase in tech demand, I think, has been a huge good news story. Parts of it that I think need to be considered, though, if you consider something like WeWork, which I think George referenced earlier. WeWork has a valuation of about $16 billion. WeWork's business model is basically an arbitrage play. I rent from Blake, I sell membership to George, and that's my business model. They do a great job. I think currently they run about maybe 90 locations across the world, and their company's worth $16 billion, apparently. Boston Properties owns 47 million square feet of office space, and they're valued at $16 billion. So, we could talk about Twitter, we could talk about Uber. One of my concerns about the tech demand is it is a more volatile sector than financial services. Typically, those tenants are not looking for 10 and 15-year terms. They're looking for 3-year terms. So if you're Blake Hutchison and you can buy a brand new building and it's tenanted by RBC, or a brand new building that's tenanted by a bunch of startups, I'm pretty sure I know what Blake would choose.
Actually, unfortunately, we have RBC and WeWorks. And actually, we have a building in Boston with WeWorks in it, and it's incubated 2 or 3 big new tenants for us.
Yeah.
So, you have to be cognizant of covenants, but they actually are a pretty good tenant to have in a reasonable measure, because they are feeding massive growth to the rest of your portfolio if you're prepared to take a little covenant risk in the short term.
Yeah, I think they do a fantastic job. I wasn't trying to take a gratuitous shot at WeWork. The point is, will Uber be here 5 years from now? I don't know. Will Twitter be here 5 years from now? I don't know. I'm pretty sure PwC will. I'm pretty sure the TD Bank will. So that whole issue of covenant and term and how it translates into value, I just think is something that we need to be careful of.
I think you gotta, those are the things, remember in Amazon in the early days when it was like, well, how did this thing, it's a bookstore, it doesn't make any money. It still doesn't make any money.
Yeah.
And it's one of the most valuable companies in the world. And I think from a space perspective, like the technology thing, the disruption of the jobs, like the jobs that are being done are being disrupted at the bottom end of the skill level.
Right.
That's going to change the need for space in the office ecosystem. So where most of this is term space, when you destroy those jobs, you've got an incubator, you've got accelerator, you've got co-working. That's kind of an important ecosystem while you're disrupting ones at the low end to invent new ones at the bottom end. So I think as a thing, it's here to stay. And whether WeWork is the winner of that one in the end, or there's others that are there, I think is a issue of market. But I think it's got an important role in the evolving ecosystem.
So it really sounds like it's the new normal, and we basically
Part
have
of
to
it.
adapt or die. So for my PwC colleagues, I mean, I hope we're still around 5 years from now. But it's a challenge that we're also experiencing as well, and continuing to make sure that we continue to stay relevant. So it sounds like it's hitting many different industries, which is great.
And I also think it's a good example of how ownership, more than ever before, needs to understand their sectors and their tenants in a way in which arguably 10 years ago you didn't have to.
100%.
If you own retail today and you don't understand retail really well, you're going to get killed, and you deserve to be killed.
To that, to that point, technology in and of itself is interesting stuff. If you're in the property business, we care about technology as it affects our customers. So we have 1 million interactions every day with our customers. Their personal devices are changing, the backbone of our retail assets are changing, the landscape of connectedness is changing, and so what matters to me, we have technology people that wake up trying to anticipate the needs of our customers every day. The more people we bring into our malls, the more we drive revenue, the more our assets go up, so it's about that. I'm a customer service person. I grew up in the service industry, and I care deeply about their experience, not about the newest and greatest thing. And so as a property owner, it's all about focusing on what's real, how do you wire it for sound, how do you make sure that we listen carefully as to what the needs are. And we've got, innovative space now for online retailers to come, online retail customers to come and pick up their product with changing rooms, with post offices so they can send and come and go. So rather than fight it, we embrace it. We're hearing that it's all about entertainment and experience, and a lot of that's technologically interfacing with our malls. So it's actually a massive opportunity when you get it right. We're spending tens of millions of dollars getting it right, and we think it's actually become a competitive advantage.
Yeah, but Blake, I think on Paul's point on office, like knowing what your tenants actually do in those spaces and listening to the tenants, I think you almost got to go one deeper and really on the office side. Insurance, back office, job processing space.
Sure.
You look at Watson and how it's being applied to customer service. A server which is like the size of a pizza box on a blade may one day replace the very jobs that are there in processing. So I think if you're asking the people who are in that job space right now, do you want blue curtain wall or green curtain wall or this or that, they may not be there. The job functions that are taking place might actually be the things to be disrupted.
But that's not disruption. That's just common sense. You got to understand your customer base. You had to 100 years ago. You got to 100 years from now. It's just common sense, getting close to your customers, understanding what they need. The best thing I've heard on the retail front, Dory Siegel of First Capital one day said quite eloquently, he goes, listen, I got all these malls across Canada. I've got grocery stores in all my malls. I understand there's disruption. I understand that a lot of these online folks are going to want to buy their groceries through, some other avenue, and some of my grocery stores will go broke. So he said, so let's assume that happens. Now I have a vacant space. Those same online grocery providers, they're going to need a space to store this product. So I'm going to offer up my old grocery store space. I may get a little less money. And now they can store that product in my old grocery store space because it goes to your last mile point. And then one of my Harvard MBA young bright people are going to step up one day and say, hey, now that all that food's in there, we should put a storefront sign out that says grocery store. Maybe that'll work, right? So it does.
Evolution.
It does come around to common sense. Yeah.
It's come full circle, I
Yeah.
suppose. Okay, no, that's great. I just want to move on to the second most talked about theme from our participants this year, and that is on housing affordability. With CMHC's report that came out recently talking about waving the red flag as it relates to housing, a lot of social media coverage, and we're starting to see government policy to sort of start to address some of these affordability concerns. Andy, maybe from your perspective, inclusionary zoning is a topic or a concept that's been alive and well in the U.S. and operating longer than perhaps it has been here in Canada. Can you share with us any insights or maybe some lessons learned that we can think about here?
Alive and well might be a little strong, but it's been in place. Found out that it's worked best in places where there isn't competition to go somewhere else, so you can put it in, and the developers can't just go the next town over. I think it's been difficult to measure whether it's been successful. I think the idea and the concept is good. I think from a social perspective, it's worked. It has achieved what it wanted to. I think it's something that's going to get a lot more discussion. Part of the problem, and this came up in multiple city discussions this year, was they want, the idea of doing that is good, and you hit on it with the social media aspect. The resistance to it is so much more organized now than it was 10 years ago, because it's so much easier to put out a Twitter page or a Facebook page and notify everybody that's going on. So they're having trouble, governments and developers are having trouble getting, a foothold with this. So it's kind of a different game. It's working. It's just been very difficult to measure how successful it's been.
Blake, any thoughts from a Canadian perspective?
So I spent a year ago, spending every Friday morning with Ed Clark and 3 or 4 other very smart people, Senator Eggleton, trying to look at our housing stock issue here in Toronto, particularly Toronto community housing. The insights that George provided are absolutely bang on. It is very broken. There's a CapEx spend that cannot be met without huge intervention by the feds and the province and the city. It has been orphaned. It's been made okay to criticize it. The city owns it, although it's sort of a standalone entity, and so it gets lots of criticism. And this problem is not going away, and it is probably, in the hierarchy of the 2 or 3 things that face our city in terms of complex problems, including infrastructure, this is one of them. Now, to take a turn and say, okay, developers, you provide it, and you provide it through, inclusionary zoning, to me is another example of really not understanding that the developer has an unending, the presumption is that there's an unending pocket there. And so I do think there are a lot of solutions. I mean, for example, with Toronto Community Housing today, if you have an asset that's in Forest Hill Village, which they do, you're not allowed to sell it. You're not allowed to sell any of the existing product. Now, if they were to sell that 200-unit enterprise, they could put in 1,000 units somewhere else, but the restrictions are such that they can't. There's a mix between RGI, which is a subsidized rent, and market that they have been held to, which is an uneconomic mix. If you change the mix for new housing stock alone and allowed more market and RGI, more developers could get in the game, more product would be provided, it would actually be affordable. When you've got a 90% adherence to these subsidized rents, you can't afford to build new product, and it exacerbates the problem. I think there are 10 solutions that are better than inclusionary zoning. Inclusionary zoning works in Paris, where, as you say, there's no new stock, you can't do anything about it. It works in high-end New York because the margins, so far at least, have been outrageous. Today, it's a net new cost. It's another layer on to a development community that is getting taxed to the hilt. And at some point, someone screams uncle, and you kill the golden goose. So I think that there are huge issues to solve. That's not the right solution to go to. I'm going to weigh in because George introduced it, and I have to take this opportunity in front of all of you to this whole parking tax idea, because I think we need everybody in this room to think about it, because we may need all of us getting behind it. There are actually 45 people in our city who we pay to wake up, called councillors, including our mayor, who are now looking at a parking tax. One of PwC's competitors came up with a study that said there's $400 million out there that we can get if we tax each parking space $1 or $1.50 a day. What they haven't figured out is that $400 million is on the backs of all of us who are commercial tax-paying players, who are now taxed the highest in the world for anybody who occupies 1 square foot of office space. So if you occupy 1 square foot of office space in the city of Toronto, it's the highest in the world, even after exchange differentials. And collectively, we pay $1.3 billion a year to the city. There's now a study that says we can get $400 million out of those very same people, because it's the exact same tax base. We can increase in 1 year the taxes on the consumers here in Toronto by 40%. If we call it something other than an increase in commercial taxes. And it hasn't dawned on our 44 councillors, I think it's now dawned on our mayor, that is just impossible. It's a double taxation. It will be fought to the hilt. He needs money next year. It'll take 4 years after the battles ensue. It's never been done. It was attempted to be done in Vancouver. They put their pen down because it was exhaustive to recalibrate everything. It's never been done anywhere in the world, and yet we've got 44 people ruminating, thinking they can get $400 million out of the exact same people who are paying the highest money in the world. So I'm bringing that up because we may all need to rally. By the way, if they do need incremental money and our city's doing its best, let's assume they are, then there are 5 or 10 other ways to get it. You're not going to get it out of one group, which is the people in this room. And you can get it through incremental commercial tax, which you can change in a minute, and you can get that money next year, and probably brace yourselves, because that's a piece of it. And there are at least 7 other better ideas than parking tax. So I had to use the opportunity to share my view, and hopefully you agree with it, because we may need all of you rallying this cry very soon. Yeah.
Speak up.
Blake will be rallying support at the end of this panel. So just in terms of that, and Blake, you've sort of touched on it. Paul, question for you. There is a view out there that the increase of supply, if we increase land supply, that would actually help mitigate some of these affordability concerns. I'm just wondering, are there any other levers or opportunities that maybe we should be thinking about?
I'll come back to inclusionary zoning maybe in a little bit if we continue this discussion, but I was in Vancouver recently, and as part of that trip, we had interviewed sort of the guru of the condo market in Vancouver, Bob Rennie, and Bob made a comment that the jurisdiction of Vancouver is the most difficult jurisdiction in North America, second only to San Francisco in terms of the timeline of taking land through the process to have it ready for development. It can take 7 to 8 years. I'm not a developer, but every developer I speak to within the GTA echoes that sentiment, that the amount of red tape, the amount of friction, the challenge of working through the process is enormous. And if that process could be streamlined and made more efficient, I think you'd begin to see a little bit of pressure coming out of the supply bubble. And the other aspect that I think works hand in glove with specific solutions to affordability like inclusionary zoning is better and bigger investment in public transportation. And I think that all of this discussion requires input from the feds and the provincial government as well, otherwise the city can't do it on its own. But if the City of Toronto had a transit grid throughout the city that was commensurate with a city of this size and scale, I think, again, a lot of our affordability issues would be lessened because developers would build in those areas. And currently, it's the same thing in Vancouver. There's all kinds of land outside of the city of Vancouver. They're just not well served by transit.
Sure. George, anything to add?
I think so. Part of that is getting the plans aligned. Like we here, no sprawl. We want transit-oriented development, and then but we need to find a place to put a new subway. And you look at the Bloor line. I'm actually taking that a lot more. 1 out of every 5 times I take it, there's something wrong with it. It's broken. We don't have the money to fix it, but we're not developing around that. Bill Rudin, I was in New York a couple weeks ago, and he said Manhattan is the best example of a public-private partnership. Why are we not developing around the Bloor-Danforth line? It's a subway. It's there. We don't have to, It's because, I think Andy called it the velvet rope in the Emerging Trends report. We want to not disturb the people who live 2 off Bloor Street. Someone's going to tell them, your house is a condo site or it's a development site. That's the plan, and move on with it. And I think until we really have an honest conversation with them, you're not aligned. So we're just fighting, we're pretending like this doesn't really exist, and we're going to stop the sprawl and intensify, and then hand that off to somebody else to fix. That's not government. That's not working. And I think that's where different thoughts have to be applied here. And taking this in a singular approach and say one thing is going to solve all this is wrong. Innovation is about trying a few things, learning from what worked, learning from what didn't work, and moving on. And
that's our biggest opportunity, I think.
And just, building off of Blake's comments about inclusionary zoning, like I think the concept is great, and I think that mixing socio and economic backgrounds and having that diversity in communities is wonderful. How you get there is a different story. The problem with inclusionary zoning as it's being discussed now is really nobody knows what it's going to look like. Province wants one thing, cities want something else. We don't know if it's going to be in lieu of Section 37, on top of Section 37, is it going to be consistently applied or not? But my concern about it, if they were to implement some form of what they're talking about, and I think George had mentioned the cost to land could be as much as $25 a foot buildable, potentially. So arguably developments in downtown Toronto, one can argue, could absorb that. Etobicoke, North York, Scarborough can't absorb that, and forget about 905. It'll make many projects completely unfeasible. So if they're not careful in the implementation, if there are not as many carrots as there are sticks, it may actually dissuade developers from building more, and you could end up with a problem that's worse rather than better.
Yeah.
So it really sounds like
100%.
we have to. It really sounds like we have to rethink kind of our public-private partnerships and really try to move this forward to address some of these concerns. While we're talking about partnerships, I'm going to change gears a little bit. One of the things that we're actually finding as well is that, and it's kind of a sub-theme that came out this year in the report, is that as mixed-use properties, master plan communities continue to grow and evolve, and there are challenges and things to consider, whether it's from an innovation standpoint, logistical, infrastructure, et cetera. We're actually seeing that there are different parties with different specializations that are actually coming together to actually form partnerships themselves. One example would be the Well in the King Portland district. So Paul, do you have any thoughts at all in just terms of this pooling of resources?
Yeah, it makes total sense. No, I mean, if we go back to what I was talking about for the REITs and you look at where they are in their evolution, they need to find new avenues of growth because you can't just keep gobbling up buildings. Their balance sheets are now big enough that they can undertake development in a way that still fits their risk profile. So in the olden days, when a REIT was smaller, if they undertook a large development and that development went into the toilet, distributions were at risk. Today, for the most part, even if something terrible were to happen with a development, like perhaps in what we're seeing in Calgary, for the most part, REIT distributions are still covered. So this is a totally logical and strategic way to move forward, and I think it makes a huge amount of sense. Rather than trying to build an in-house development team and the cost and acquiring that expertise, which is difficult, they're partnering with the best players out there, and from what I've seen so far, it's being done in a fairly disciplined way, and I think it makes sense for all parties involved.
Absolutely. Blake, from a pension perspective, are you able to share with us some of the partnering that you're doing on your side?
So the question is, from Oxford's perspective, what are we doing? I'm going to talk about OMERS for a second. I think the biggest issue to me right now with the big infrastructure transactions is that there isn't one data set. That a province will do its math, the feds will do their math, the city will do their math. Everybody has a different set of overlays for political issues and other things, and there's no sort of lockbox that says this infrastructure costs X. Here's what the deliverable will be, here's the I get, you get formula on how we pay it, and somehow we need to establish a norm. It'd be a good job for one of the accounting firms to say this is an unassailable underwriting as to what this actually delivers and what it doesn't deliver. Because by doing that, first of all, you can suppress, you'll never get rid of it all, the political noise. Second of all, people will actually understand what the cost, benefit, and reward can be, and then you can actually engage the private sector. The issue today is there's so many moving pieces, and when you have a legacy of, gross overcost, gross overspend on the York subway or the Union Station or whatever the weather, to weigh in and expect private sector to marry that is very difficult. And so if you can prioritize properly, if you can get the math right, then there's a huge opportunity to engage the pension fund capital in this country that is massive and going everywhere but Canada, because the opportunities just don't exist to get at these issues. And, you know, OMERS, for example, would be delighted to marry half of the projects that are on the block, but they can't get their arms around how they'll look and how the math flows and what the formulas may be. So that's where the loss is. It's not that there isn't a desire, both by government and private sector, to marry. There's just an inability to get there because of the complexity. In terms of, in terms of partnership strategies, they are alive and well in everything that is happening in the globe today. And our book today, as I said, is $43 billion. 31 of that's our money, 12's partnerships. Of the 12 that are partnerships, they basically pay the overhead of the business. It costs us $200 million to run Oxford. I collect $188 million of fees from my partnerships. So I go to the board every year, I go, it's costing me $12 million this year to run a $43 billion business with an 11 or 12% return. That formula works pretty well. And the trick for us is really to try to, it's not so bad. It's not so good. But the trick is to, to get an asset to a point where it's stable. So by that you mean you develop it, you bring in-house your development profit, and then the run rate stability, you can bring in a half-interest partner.
Right.
And so we tend to go 50% our money at a certain point, 50% other financial capital. We have a $8 billion relationship with CPPIB, for example, and that's 4 of our money, 4 of theirs. We manage the assets. They've been great partners. AIMCO's been a great partner. Brookfield in England's been a great partner. So Canadians are traveling in packs. It is a trend. We are working together. Makes total sense, and if you sell half of something and you get fees on the new half, your return on equity goes up. So it is a logical business proposition.
It just makes logical sense at the
Makes
end of the
sense.
day. Okay. Just given the interest of time, I did want to get some of your thoughts on the outlooks and sort of best bets going forward. So we've talked a lot about some of the factors that are impacting the real estate industry. Would love to get your thoughts on where you think the various asset classes are going to be over the next 5 years. George, maybe we'll start with you on high-rise, residential, multi-res. Take your pick.
So outlook on res?
Outlook on where is it going? Where do you see it going in the next 5 years?
Okay, so I think if you pull those apart, for low rise, changes to the growth plan. So the Prices to Grow Act for low rise is likely going to see more of that. We're going to create a policy framework which is going to be more of the same. I think the average house here made more money this year than the average household. I think that's going to continue into next year and likely beyond. On the high rise, I think there's a few things that are there. I think there's a delicate swing here between how much of that is condo, how much of that is rental. I think most of that's going to go on the back of the strength of the condo market, which right now is at probably record strength. I think we're going to get a new act coming in place next year. How we absorb that change is going to be either a little, speed bump or a stumble, and then that may change the switch one to the other. I think you got some emerging issues that are going to take place in the stock of managing condo buildings going forward. A lot of the value engineering has been taking place at minimizing costs, not thinking about long term. I think that's going to be something to watch. And I think overall, you've got the right fundamentals in this market. We've got more people coming here. We need to have new housing. The challenge is no one's really in charge, and we have this great, conflict of policies that are making it very hard and very expensive to actually execute that.
Right. So some challenges we definitely need to think through. Paul, what about on the commercial industrial side? Any predictions on that?
On the industrial side?
Commercial as well.
Sorry?
Commercial or industrial?
Well, commercial is a broad topic. I'll go with industrial. And the question is, how do I see it over the next 5 years?
Outlook for the next 5 years.
I mean, listen, the industrial sector, for as long as I've been in the business, has been healthy, great. in demand. The very defensive qualities of it makes it even more in demand today. Like every other part of the sector, it's evolving and it's changing. But as we see, a shift from pure retail into logistics, a lot of people are calling, industrial the new retail. There's a new source of demand for warehouse product, logistics products that wasn't there 10 years ago. I love the sector because the supply tap can be turned off very, very quickly. I've never seen vacancy rates in Canada in the industrial sector float much higher than maybe 6%. It's always lower than in the US. In Vancouver, the port influence is huge. Toronto is now, I think, maybe the second or third largest industrial market in North America. So when I look at the whole Canadian landscape, and even Calgary, when despite all the challenges it has, it is the distribution hub of Canada. That's not going away. And as Andy had mentioned earlier, we're seeing this new source of demand of smaller buildings which would have been considered to be functionally obsolete a few years ago, but if they're well located in close proximity to urban centers, they may very well be worth gold as this whole push towards same-day delivery happens in Canada. So overall, I'm not sure there is a more defensive and more stable sector right now in Canada than the industrial sector.
Excellent. And Blake, from an office perspective?
So from an office, 50% of our book's office. So it is hard to generalize because every city's different. And real estate is a function of supply and demand. And if you ever lose sight of that, you're in trouble. So, Halifax, the office market's a little weak. Ottawa, it's definitely weak. Montreal, it's weak. Edmonton, Calgary. Calgary, worse than Edmonton, is weak. And as Andy suggested, Vancouver and Toronto, net effective rents are going up, supply and demand are in check, and they're great. Now, having read your study, if you get, like Calgary did, 1, 1, 1 in a row and then 2 nines, if you say that, Vancouver and Toronto are going to be 1, 1, 1 or 1 and 2, does that mean they're going to be 2 nines? I don't know. So you get nervous if you start to believe your own stuff. But in terms of, it really is market specific. It really depends on the asset class you're in. But generally speaking, Toronto and Vancouver are doing fine. I think there's hope for both Montreal and Montreal and Ottawa in the short term. And Calgary is going to be a long time digging out of this. And so as an asset class, it's pretty capital intensive. And so, the better assets by definition will do better. A churn from the older product to the new makes sense. Our dirty little secret is people like new. And so new product in the best cities with good supply and demand fundamentals we believe in. And that definitely includes Toronto and Vancouver. To a lesser extent in the short term, Ottawa, Montreal. And I think we all have to tiptoe carefully in Alberta.
Okay, great. Andy, from your perspective, are there any trends or anything that you're seeing from a U.S. perspective that we should probably be thinking about here in Canada?
Probably this year, the trends that we looked at were very similar, and they were really created almost in separate tracks going by. So if there's anything new, I think we've kind of touched on it, but it would maybe be that optionality trend, which I think is just getting started, and it'll be interesting to see, especially the concept of a company not really having space, but I think Blake touched on having WeWorks and they spinning out tenants. I think we'll begin to see more where people want to have that flexible space in their building so they can go up or down. And then Paul mentioned the 3-year lease. I think that trend toward shorter leases and kind of that evolution. We're seeing more of that in the US this year than, or at least people are talking about it more than they ever did before. Didn't hear quite as much about it in the Canada interview, so we'll see if that filters up into the market.
Gotcha.
All right, I'm going to ask my final question. So this is always my favorite question whenever I go out and do these interviews for this publication. If you had funds to invest in real estate, A, in which asset class would you invest it in? And B, which geographical location would that asset reside? Paul, you want to start with you?
What's the question? If we had
Well, I want to start by saying I think it's a terrible question.
but which?
What and where?
Because it depends on how much capital and, I mean, every buyer is different. I mean, if you're somebody who's looking for safety and security, you want one thing. If you're looking for opportunity and hit a home run, you do something else. If I was just a really rich guy in Toronto, I would take a look at where the relief line in downtown Toronto is most likely going to run, and I would try and buy everything I could underneath it or underneath the planned stations. And I would hope like hell that in 30 years, maybe somebody's riding that subway. If you look at the explosion of land values along Yonge Street, I think that'll be duplicated at some point, and hopefully that line gets built at some point. And I think if I had, you know, Blake Hutchison money, and I had the opportunity to invest all around the world, I think the only thing I would say is I think the market continues to bifurcate, and I think there is a big shift going on between the best of the best and everyone else. And if I was a global pension fund and I had the ability to allocate capital, I would be going to the best of the best in each sector and to the best cities in the world, not necessarily countries. I don't think countries matter that much. I think cities matter. Yeah. And I think those locations are shrinking from what they would have been maybe 10 years ago.
Great. George?
So I'm going to take a different tack to that. I would say partner in ventures that have a tech DNA to them, that are going to solve problems here in Toronto that you could scale outside of this region in the world. And while trying to figure that out, I'd buy restaurants on the Danforth, have coffee with these guys, and wait for the inevitable.
Spot the Greek guy. And if I had George's money,
Blake, you could buy Greece.
I'll get you a deal.
what did he say?
You could buy Greece.
Oh, there you go. So I wish it was our money. So I think actually Paul's point's good. We are very fortunate to be able to look around the world. We have been very careful about where we've invested. We've been totally city-state focused, not country focused. We have 3 city blocks in London we like. We have 4 in Paris we like. We have 2 in New York we like. We have 3 in Boston we like. We have 1 in Washington we like. And we like a couple of windows here in Canada. So we've been really city-state focused, really true to a 5-year strategy that's been consistent. And so we're you know, as disciplined as you could be. I'll tell you one deal that we have done in the last couple weeks, which would be counterintuitive to most, and that is we bought a $400 million retail asset in London on New Bond Street, which is the Bloor Street of London, the best high street retail in London. We had this asset under contract prior to Brexit. We negotiated a £5 million Brexit clause that basically said for £5 million extra, if the vote goes the wrong way on June 23rd, we can put our pen down and drop the transaction, which we did. So we waited 3 weeks. They came back to us and said, how about a 7% discount? And we said, okay, maybe. And this is 3 leases that are 10-year leases, so it's not volatile in the short term. It's the same leases that existed prior to the 23rd of June. So with a 7% discount, which then became an 8% discount, and then you factor in Canadian currency, the $400 million asset now costs us $320 million. So same asset, same tenancy, post-Brexit, 10-year return, we hit the bid with partners. So we bought half, our partners bought half. So that's not a bad, that seems counterintuitive. I like those transactions. So I was there earlier this week. Again, we're not going to put pen down in the UK. We're going to focus on the same couple of city streets that we like in London, and if those kinds of opportunities come up and our currency gives us 20% more buying power, not so bad. So that would be an observation. In Canada, you know, I think, Paul, you pointed out, if you do something exquisitely, it will have value. If you use some great architects and be very thoughtful about it and create something new or renovate something from old, if you do, I just find every time when you execute exquisitely, you're going to do beautifully. And so that would be more of a theme than an absolute asset. And I just wanted to end by saying I don't want to be the big Oxford complaining about taxes as it affects us, because that parking tax issue doesn't actually affect us. It doesn't affect the big guys. Any flat tax, by definition, hurts the little guys, because it's straight across the board for everybody. So if a politician looks at you and say, you own Yorkdale, you can afford it, it's not that. It actually goes passing through to our small retailers, our small industrial players and the like. And I just wanted to make that clear to this room prior to having to give up the mic. So,
Great, thank you. So, thank you for that. So we've covered a lot of ground this morning. I think if I was to combine it all together, I'd say the key messages or the themes that we've heard this year are new forces and the future disruptors. Affordability continues to be a concern that we need to address. There are complexities that we're trying to address through new partnerships and innovative ways of working. And we've talked about some of the best bets and outlooks going forward. So with that, I just want to thank all of our panelists for joining us today and for sharing your insights. That was great. Thank you.
Thank you, Nadia, and again, Andy, thank you. I also want to thank our panel, Blake, George, and Paul. I think this year proved to be the spiciest and most diverse of conversation we've had, at least in many years. And it might be the coffee, it might be the times, but it certainly appreciated your frankness and leaves a lot to think about. Very quickly, as we sign everybody off on time, our signature, I also want to thank, on behalf of our management committee, Derek Goring, our chair, who I thought had already left because he was going to come up here and do this, but he's staying just a little extra long. Thank you to our board. Thank you to our event sponsors. Take one of these. These are fantastic. This is Quadrangle's pad, and thank you, Quadrangle, for being a sponsor of this event for this year, and also RJC, my initials, RJC, for your sponsorship support. Nice chocolates to take away as well. So with that, we close our 2017 Annual Trends event, and thank you all. Have a great day.